Hi everyone, my name is Lucian. Most of you know me from Twitter as Triangle Investor. Today I am joined by one of a familiar name from uranium space. That is Justin Huhn from Uranium Insider. Justin, welcome and thank you for coming up.
Thank you, Lucian. Happy to be here with you.
Thanks. Justin, let's start with the basic question for you. On the scale from 1 to 10, how bullish are you on uranium at this very moment?
Oh gosh. I would say I'm probably at an 11. The only thing that has me, let's say, slightly less bullish in the short term has nothing to do with uranium itself. And that just has to do with complicated macro environment, interest rate environment, kind of overbought tech sector that looks due for a correction. Plenty of very intelligent, respectable macro folks and very successful long-term investors that are waving the warning flag as far as economies and markets generally speaking. So I think there's still kind of some general macro headwinds possibly out there. Of course, as I say this, the broad markets continue to melt up and just absolutely destroy the shorts, which the market loves to do. So those, like I said, those things have nothing to do with uranium itself. Looking at the broad factors for the uranium market, it's the setup is pretty astounding. It's truly quite positive on so many fronts. And I mean, we're in the very early innings of a contracting cycle. The physical uranium market is extremely thin, the thinnest I've ever seen it. And as far as I can tell, possibly the thinnest it's ever been. I can share a couple of details on that if you'd like. And nuclear energy continues to grow. 2 more restarts in Japan are happening in the next couple of months. Sweden is doing a 180 on nuclear and looking at new builds. Poland is going all out. Turkey is building new plants. China, of course, is going absolutely nuts with nuclear builds. The US, who knows on new builds, but they're at least supporting the existing fleet. It's all looking very positive, and the demand picture is very reliable. The supply picture, however, is not. And the supply that needs to come online is going to have problems, is going to take longer, it is going to cost more, as it always does. So all of those elements together just paint a picture of a very bullish environment for the coming years for uranium.
Agreed 100%. I want to touch on Zuri Invest. We will not see a full transparency like we did with Spot, the funds they raised, any other details. The only thing we will be able to monitor is daily NAV on Bloomberg. So in your opinion, when do you see first notable buying from them, and how much pressure on the spot market can we expect through the purchasing period?
Well, we did already see their first buying. So that was the later part of last week, earlier this week, as we're recording this on June 22nd. Yes. So I think that they already did a little bit of buying, and the further buying is going to be dictated by additional capital flows coming into the vehicle. And they are being very opaque with what they're sharing, and that's by design. I kind of appreciate that on a certain front. I mean, we like to have as much information as we possibly can, and Sput, of course, has been extremely transparent with every penny they've raised and every pound they've purchased. Yes. And this is a whole different mechanism. So different vehicle, different style, has some healthy competition in the market for investors' ability to have exposure to physical uranium. Hard to predict what they're going to do going forward. It's going to be completely dictated by capital flows, but it's going to be a different type of investor that invests in Zuri, an investor that wants to have exposure at NAV all the time, that wants to be able to sell their position in physical uranium at some point, and is a patient investor, because if they don't have the cash on their balance sheet to liquidate a sell order for Zuri, they're going to have to, if they can't cross it off with a buy order, they'll have to sell uranium in order to liquidate that investor. So that's a whole different style. And I for one appreciate it. I like that it's less transparent, and it's just like, oh, it's just kind of there. They're going to be doing something, but most of the market is not going to be privy to what they're up to. So, it's going to have some effect And leading up to their purchasing, we saw a $4 or $5 jump in the spot price over the course of about a month and a half leading up to their first purchasing. Then when they were doing their purchasing, they were demanding front month settlement. And we did hear about that. And so that moved the price up another $1.50 after that run. And it's pulled back down about $1.50. As of yesterday, it was starting to move back up again. But it's going to have an effect. It just nobody has any idea how much of an effect, because that's going to be dictated by capital flows that it's impossible to predict.
Yes, of course. One eternal question that nobody knows the exact answer, and that is how many material is available out there for sale on the spot market, and do you think that spot market is drying up?
You know, it's a common misconception amongst let's say retail investors in the space that the spot market is sort of this large bucket of uranium, and once it's gone, it's gone. And that's just not how it works. It's all sort of the same market. It's just that the spot market is 12 months settlement or sooner. And so if you buy, if you're a utility and you're looking for 2025 delivery, that's relatively near term at this point, but it's not technically a spot market transaction because we're going out 18 months, right?
Yeah.
But it's still the same market. You're still buying essentially from the same providers of that material. So we're never going to get to a point where there's zero uranium in the spot market, and that's just how it's going to be forever. There's always some material for sale, especially if we see higher prices. There has been and likely will still be certain producers that primarily sell into the spot market. And one of those would be BHP. They operate the Olympic Dam mine in Australia. That's a gigantic mine. It's primarily a gold and copper mine, but they produce somewhere to the tune of 8 million pounds a year of uranium. But it's essentially sort of a bonus for them because they're primarily producing gold and copper. So the uranium that is kind of an extra element that they produce there, they just sell primarily into the spot market. Sometimes they'll do market reference short-term contracts, but so they sell, a bit into the spot market almost on a monthly basis. There's a couple of others, a couple of traders with off takes. So generally speaking, maybe there's 1.5 to 2.5 million pounds per month that in theory can be made available into the spot market.
Yeah.
But there's plenty of evidence out there that there's not a lot of material available. And the spot market and the term market are inextricably linked. And so when you have very, very tight supply in the term side, especially for the near to midterm. So for example, the primary producers, that would be Cameco and Orano and Kazatomprom primarily, they are mostly sold out going out through 2026. So they only have so much production on an annual basis. And those three players primarily produce into the term market, sell into the term market. And once that supply is tight, there's not a lot left available in the spot market. And so what we've heard lately is that there have been some players within the fuel cycle services providers that have put out requests for proposals, RFPs for uranium, for U3O8, in order to run through their processes to sell the product of their processes, so UF6 or EUP, to utilities that are also putting RFPs out in the market. And they're not getting filled on those uranium RFPs. So looking for 2.5 million pounds for 2024 to 2026 and getting offers that are less than half of the volume that they're looking for. This is not something that we have ever seen or have ever heard of, including the previous bull market in uranium. So when funds were buying hand over fist and the Chinese were coming in heavy into the term market, 2005, 2006, 2007, we never saw a situation where a 2 million pound RFP didn't get filled. So this is a new era in the uranium market, and what we've been talking about for the past year or so. And of course, this has been quasi theoretical forever, which is utilities will always prioritize the later stages of the fuel cycle because you can get the material sooner if you can just go and buy EUP, or you can buy UF6 and have it enriched, and you skip the first two steps of uranium mining and conversion, right? So once those two steps are secured for the bulk of the utilities, and I'm not saying that they are, but they're more secured than uranium. So utilities, generally speaking, are far less covered for U3O8 than they are for conversion and enrichment going out in the future. And that's reflected in the pricing of these services. So we've seen huge spikes in conversion and enrichment, especially over the past year, although both have been in an uptrend for multiple years.
Yes, they did.
So the theory, and it's not really a theory that we're just throwing out there, but it's very obvious. And when you understand the fuel cycle, it becomes obvious is once those services are provided, you have to buy the thing to feed into those services. And that's uranium. And so that is finally coming, those chickens are coming home to roost at this point. Uranium demand is hitting the market, and it's here to stay for a number of years.
You touched on BHP. I would like to see, is there a potential danger of price declining if we see a scenario where Kazakhs ramp production, Cameco with McArthur River ramps production, and BHP eventually with Olympic Dam? Do we see a danger of spot price declining in those scenarios?
Well, I mean, I guess there's always a short-term danger, as you put it, in price fluctuations based on supply increasing or decreasing, right? And the spot market is going to have multiple ticks on a daily basis, up or down. It doesn't really reflect the overall market. The utilities secure 85% of their needs in the long-term market. Yeah. So spot price fluctuations are not necessarily evidence of a oversupplied or undersupplied market. While even though they do generally reflect that, it's not, small moves in the market are not evidence of that necessarily.
Agreed.
There's certainly supply out there that could come into the market at higher prices. And that, of course, has been 100% theoretical. So, we have some Japanese utilities, for example, who operated plants that have been permanently shut down. A lot of that inventory that is fungible, so that would be U3O8 or UF6 or potentially EUP, has already been sold into the market. Some of those utilities paid, $70, $80, $90 a pound in the previous market. Perhaps they'll sell some of that material back into the market when we reach those prices. That is theoretical. Thus far, even though we've seen the price go from $18 a pound to almost 60 now, we've seen a spike above 60 last year, but that was financial market driven. Yeah. Now that we're pushing $60 a pound based on sector fundamental needs, we're not seeing evidence of that. So as of now, there really isn't evidence of more pounds shaking out into the market as prices rise. And historically, that has not been the case either. When the price tends to rise, there tends to be concern in the market on the side of the utilities that supply is becoming increasingly scarce, and it's time to build our coffers, let's say. So inventories have been drawing down, generally speaking, in the West for multiple years. They're not at crazy panic scarcity levels. But for example, the inventories for nuclear utilities in the United States fell by 4% last year. Last year, when the fuel cycle got completely shaken up with this bifurcated situation due to Russia's involvement in the invasion of Ukraine and Western utilities essentially avoiding new business with them. But inventories did not get restocked even in that type of scenario. So there is some inventory restocking that needs to happen. And a lot of times when we see a rising price environment, rather than the logical trader mentality is, hey, I bought some pounds at $30, I'm going to sell them at 60 and double my money. That does make sense. But if you're an operator within the industry, you're not necessarily looking at short-term trades to make a little bit of profit. You're looking at your necessary requirements for fuel to operate a multi-billion-dollar asset. And that's the way that utilities look at it. They're not looking to flip some pounds to make a little bit of profit. They're looking at securing fuel to operate their facility. And a rising price environment equals a scarcity in supply. And the reaction to that typically is more buying, not more selling.
What about US banning uranium imports from Russia? How will this unfold, in your opinion?
Well, as of right now, the legislation that's moving through the United States Congress, primarily this would be something called the Advance Act, has an element to it where Russian uranium would be banned for import to the United States. There are a couple of caveats to this, which are that waivers can be granted by the Department of Energy to a particular nuclear utility to receive a shipment of Russian uranium if they can prove that they literally have no other option, A, or B, if it's determined that it is a national security concern for that material to not arrive. So it's hard to say what the short-term effects will be, but I do think that it will have an effect. And the reason for that is it's highly possible that Russia could have a response to this legislation passing in, okay, you're going to sanction our material, well, we're just not going to send it to you anymore. So there's been a lot of material received from Russia over the past 12 months as utilities have been able to. So there are flex provisions in contracts. So a producer or a seller of uranium or uranium fuel cycle services or products offers provisions within these contracts typically where the utility can flex up either the volume that they've contracted or the time frame in which that delivery takes place. So if you have a delivery for 2022 to 2025 for EUP coming from Rosatom or Uranium One or 10X, you might be able to actually flex up that volume. So you can say, okay, I have X amount, I can flex it up by 20%, or I can rush that delivery. And that is something that has been taking place, not only just for Russian material, but generally all around. So the utilities have continued to receive deliveries from Russia on legacy contracts. If this material is officially sanctioned through the passing of this act, I do believe that that's going to shake up the market. I think that utilities are not going to rely on these waivers. They're going to have to take action because utilities do not like supply risk, period. So there's going to be voluntary actions taken by utilities despite the offering of waivers. And it's entirely possible that Russia just says, yeah, we're cutting you off. So it's going to shake up the market. There's going to be a price response, and there's probably going to be an equities response. It's not a guarantee that this passes, of course, but I think the legislation that's going through Congress now probably has the best chance of passing of anything that we've seen that has had elements of Russian uranium sanctioning over the past year.
Justin, what about long-term agreements? We all know that majority of the companies do not disclose the delivery price of U308 to utilities, and that price has few factors calculated in. But do you believe that with every new contract signed, the ceiling price and the floor price goes up, or we see the similar levels like we did like 1 year ago or 6 months?
Sure. Well, even though the reported term uranium price is based on the low offer, so that price is reported once a month at the end of the month by UXC and Trade Tech. UXC, I would argue, is the larger of the two in terms of visibility to the market and to nuclear utilities, generally speaking. Their term market price that they publish continues to rise. It made a $2 or $3 jump last month. And even though that is reported as the low offer, so there can be 20 million pounds signed in any given month. And if 500,000 pounds was offered for delivery out 18 months, that's not a spot market transaction. That would be a term market transaction. And that's offered significantly lower than what has been signed for the rest of the 19.5 million pounds. That is the price that gets printed. This price, the long-term price that is published, is, in my opinion, sort of a gift to the utilities, because that is the price that is paid upon delivery from market reference contracts. It's basically the spot market forward pricing, and it's a price point to start negotiations at. Now, their published 3-year forward, 5-year forward prices are significantly higher, and those more accurately represent fixed prices within these contracts. But more and more of the contracts, from what we're hearing from our industry contacts, are increasingly market referenced. So a smaller and smaller percentage of these new contracts are actually fixed price. The primary fixed price contracts that we're hearing about are coming from developers of greenfield projects and or restarts of brownfield projects. So because those contracts, utilities have a little bit of leverage because those contracts are needed to de-risk that development. and to de-risk the financing of that development. So if you're getting a greenfield mine into development that is set to produce in the next 2-3 years, the financiers need some de-risking. So they need to see that there are some contracts signed. Therefore, the utilities that sign contracts with greenfield developers have a little bit of leverage, and they'll tend to seek. Utilities want fixed, producers want market reference, and they have to meet somewhere in the middle. Well, right now, the reliable primary producers of the world have all of the leverage, and they hold all of the cards and all of the power in these negotiations. So that's, you know, Cameco and Kazatomprom and Orano and a number of traders as well. And there's a few others, BHP, but for the most part, those are the big players. And they are increasingly seeking fixed term referenced, market referenced term contracts where at the time of delivery, that published long-term price is what they receive, even though it's on the low side compared to what's actually being signed right now. That's the price that's paid upon delivery. And of course, there's floors and ceilings when you have market reference. So the floor, of course, protects the producer, and the ceiling protects the utility. So they at least have some security knowing they will never pay above X price. But everything that we can hear is that floors and ceilings are moving up with every information leak that gets out there into the market. I think that we're seeing, you know, when we're looking at delivery in the later part of the decade, we're seeing ceilings, you know, north of $80 a pound now, even though we've got a spot price of $57.
Justin, a lot of new uranium investors that come to the market are not familiar with some basic terms in the uranium processing cycle, like, for example, enrichment, or maybe term overfeeding. Can you explain to an average investor both of those terms, and what kind of difficulties we are seeing in this process?
Sure. Well, just kind of higher level 30,000 foot view, nuclear reactor doesn't run generally on natural uranium. So you mine uranium out of the ground, it goes through some mild processing to essentially turn it into yellow cake, what is known as yellow cake. That's U3O8. So tri-uranium octoxide, right? That's the yellow cake. That's the first stage of the cycle. CANDU reactors, which are the Canadian design heavy water reactors, do run on unenriched uranium fuel. So that's about 10% of the global fleet are CANDU reactors. Those are mostly in Canada. In fact, all of Canada's reactors are CANDU reactors, heavy water reactors. But the bulk of the world's fleet is light water reactors and boiling water.
Yes.
And those run on enriched uranium. So the actual fissile isotope within the uranium atom is U-235, and it occurs naturally at 0.7% of the total mass of uranium. So that has to be enriched to a higher level of the U-235. But in order to do that in the primary method of enrichment right now, which is centrifuge, gaseous centrifuge enrichment facilities.
Yeah.
So the uranium itself, the solid, the yellow cake, has to be converted into a gas, and that goes through the process of conversion to turn it into uranium hexafluoride. I don't fully understand that process. It's a chemical process, but it turns it into a gas, and that gets sent to the enricher. The enricher runs that gas through a cascade of centrifuges where that U-235 is enriched from 0.7% to somewhere between 4 and 5%, usually about 4.5%. It then gets deconverted back into a solid and processed into uranium fuel pellets and made into fuel rods that are sent to the reactor. And so this whole process takes a very long time, depending on where the uranium is mined, converted, and enriched. So if it's mined in Kazakhstan, converted and enriched in Russia, it might take 12 months. If it's mined in Canada, converted in Canada, enriched in the United States or in Europe, fabricated in Europe, that process might take 24 months. So it takes, 12 to 24 months for this entire fuel cycle to go from uranium pulled out of the ground to fabricated fuel rods sent back to the utility. The process of enrichment is really probably the most interesting aspect of this fuel cycle, because there's limited capacity, of course, and the way that the market is setting up right now, and it's so unique, is that most of the world's reactors exist in the quote unquote Western world. So these are the OECD countries. This is, North America and Europe primarily, is about 70% of the world's nuclear reactors. Those utilities in those countries generally are avoiding new business with Russia. Russia has, they are the largest player in both conversion and enrichment. So they've got 43% of the world's enrichment capacity, 38% of the world's conversion capacity. So when you have most of the demand in the West and the biggest player of these services in the East, that shakes up the market. That's what we're seeing right now. That's why we've seen the prices of conversion and enrichment skyrocket over the past year and remain high as of now, and they're probably going to go higher. So basically what that means is when you're seeing increased demand for these services and capacity is limited, the enrichers actually have some flex in order to produce more enriched uranium with a fixed capacity. Conversion doesn't have that option, enrichment does. And what they can do basically is move that material faster through that enrichment process, use less SWU. SWU is separative work unit. It's the cost of enriching, the amount of energy that's used in the enrichment process. So they can actually run it through faster. But what that means is they need more feedstock coming in the front end of that process in order to move it through faster. That's kind of higher level. It would take time to drill into that. But basically, long story short, enrichers can meet the needs of the West. Western enrichers can meet the needs of the Western utilities, but they need more material fed into the front end of that process to do it. That is overfeeding essentially, and that's what we're seeing.
Well said. I would like to discuss uranium exploration and mining jurisdictions. What's your take on jurisdictions like Namibia and Niger?
Well, they both have a very long history of uranium production. So, Namibia historically has been a very, very quote unquote safe jurisdiction for uranium production. It's been a place where investors feel safe in investing there. There currently is uranium production there that is primarily coming from the Chinese operating the Husab mine. There's also the Rossing mine, which is in later stages of production. And then, of course, there's Paladin's Langer Heinrich that is a brownfield that is in a certain stage of restart at this point. Recently, there was news that came out last month that a member, I don't remember who exactly it was, a member of the mining ministry, let's say, had mentioned in a conference that they were looking at taking a stake in mining operations, and that shook up the market. Some of the Australian listed Namibian uranium mining plays sold off pretty hard, then recovered pretty strongly within the last couple of days following, because that was essentially refuted that existing licensed producers and developers are not going to have to give a stake to the country of Namibia. Niger, automatically, the country of Niger has a 10% stake in uranium mines that are there, and they can negotiate a higher stake. It's one of, if not the poorest countries on the planet. The French have a presence there. They've been mining uranium for a very, very long time. It's a crucial element of the Nigerian economy. And so necessity is the mother of invention. They need uranium mining in that country, full stop. So, is it a safe jurisdiction? Well, I think that there's certain risks that you'll have in a country like Niger that you wouldn't necessarily have in Saskatchewan, but they have a very long-standing history of uranium production. So while they might not be the absolute safest, that uranium mining history should give investors a bit of a trust in those jurisdictions, in my opinion.
Do you think that we will see new production project in Athabasca by 2030 beside maybe Denison Mine, the Wheeler River project?
Yes, I do. I do. We're probably going to see some further mining and production from Orano with this Sabre technology they've been testing out. This is basically jet boring within a borehole, and the drill rig can actually extract the slurry rather than building a mine down underground. It's a new technology they've been testing for a number of years and successfully. So we'll probably see them expand that methodology and start to mine in some of their own properties that are in the Athabasca. Cameco perhaps will expand Cigar Lake, because Cigar Lake really, phase one of Cigar Lake, which they're still currently in, is set to sort of run out of ore of 2028, 2029-ish. So they might get into phase two. They're also drilling on the other side of the property line from ISO Energy's Hurricane deposit. Yeah. So we'll see what they find there. NextGen's Arrow, there's a lot of speculation about this deposit. It's obviously a massive deposit, very high grades, huge, incredibly high IRR for that. Even though the capex of that is probably blown out a bit since their feasibility study, but we're probably, even if they have to spend 1.5 to 2 billion, that investment is repaid within about a 12-month period based on their feasibility study. Absolutely insane, huge grades. But it's very deep. It's 800 plus meters deep. Infrastructure needs to be built. A mill needs to be built. These things take time, an incredible amount of capex. So, but I do believe the Arrow will produce before the end of the decade. I do believe that. And then you have, let's see, Denison's Wheeler River property with the Phoenix deposit. They've been successfully testing ISR. That's a first for the Athabasca Basin. That looks good so far. They're in the final stages of that testing process. So I do believe that will produce this decade as well. As far as the exploration projects that are in the Athabasca, that's a big ask for those to be producing within the next 5 years. So hard to say on those, but the ones that I mentioned, I do believe will be producing by 2030.
And do you see more M&As among Athabasca juniors or explorers or not producers, sorry, development companies?
Yeah, I think there's going to be more M&A in the sector generally, not even necessarily specific to the Athabasca. We've seen a decent amount of M&A. It's slowed down over the past 6 months or so. There's been a few, but last year there were quite a few M&A transactions. There's going to be more. Yeah, the sector could use some consolidation, in my opinion.
Okay. Let's discuss evaluating uranium companies. What are your top 3 metrics that you use to identify a good project?
Top 3. That's a good question. I don't think I've ever been asked that. Management, jurisdiction, and share structure.
Okay. But when you are identifying a project, a land, a property, what do you look for there as a top metric?
Well, I think jurisdiction would probably be the first, and then the size and the grade and the mineability of the deposit probably would be the second. And of course, all of these things are not super hard lines. If a company is cheap enough, the deposit doesn't have to be super high grade, et cetera, et cetera. You have to make balanced decisions on weighing these various elements that might dictate your decision to invest in a company. But yeah, jurisdiction is very, very important.
Okay. Justin, what are your 5 biggest red flags when you are doing a due diligence on some company, uranium company, and what keeps you away from buying those kind of stocks?
That's a good question too. 5 red flags.
Yes.
5 biggest red flags. Might be hard to come up with 5, but let's see. I would say a blown out share structure would probably be my #1 red flag. It's very, very difficult to operate a small cap mining company, especially an exploration company, because if your market capitalization is so small, even to do a relatively small drill program, you still got to raise a few $1 million. And if that ends up diluting your shareholders by 20%, it's just a tough game. It's a tough game for small cap explorers, period. So we generally avoid speculating on small cap exploring stocks just with the service that we provide due to liquidity and share structure blowouts. But
yes,
the share structure being blown out as far as having billions of shares outstanding, so that would be the first red flag. And that's not always a deal breaker. Most of the mining stocks listed on the ASX have huge share structures, very large outstanding shares.
Yes.
But as far as the actual structure of the outstanding shares, it's important to look at outstanding warrants and options and recognize what percentage of the total number of outstanding shares those are. And so if you have outstanding warrants and options that are like 50+% of the outstanding shares, that's a lot. And you got to start, you have to at least dig into that and figure out why that is. So that's a pretty big red flag. You know, and not necessarily a red flag, but every single company is going to say that they're in the first quartile of cost and that they've got the next big thing, and barely any of them actually are. So you have to look into, you know, the actual costs of what they plan to do. Let's see, other red flags. I would say, you know, the biggest red flag would be a risky jurisdiction. So, you know, there's plenty of exploration companies that are in jurisdictions that have never produced a single pound of uranium, and they're speculating on maybe an illegal jurisdiction becoming legal. You know, that's just not a bet that we want to make. If you are invested in a company that is in a borderline jurisdiction that does turn pro uranium, of course you can make a lot of money on that speculation, but it's a gamble. And I don't believe that investing is gambling. I think that you have to do your own research into what you're doing in order to increase the chances of you coming out on top with your investment. So gambling on jurisdiction, you know, management, obviously, if there's a member or multiple members of management that have been involved in shady business in the past, that's an obvious red flag. I think that was 5. That's probably good.
What about skin in the game?
Skin in the game is important. That also has a lot to do with the market capitalization of the company as well. So if you're operating a $1 billion market capitalization company, and you wouldn't expect the CEO to own 10% of that necessarily. But, you know, the smaller companies, let's say less than 100 million, you want to see at least a decent percentage of insider ownership and institutional ownership. So if management has very little skin in the game and it's a smaller company, you should actually literally be asking them, what's up? Why do you not own more of your company? You know, and of course, skin in the game also sometimes influences companies' actions in a negative manner. So for example, a company might need to raise a certain amount of money for something that they're doing, whether that's exploration or development of an asset. And if management owns a very, very large amount of shares, they might be less willing to offer up that dilution to raise the necessary capital to do what they need to do. And they might be punished by the market for it. There's a company in particular, I'm not going to mention who they are, but they needed X amount of money. They raised about half of what they needed. The market knew they needed to come in and raise more. And because they didn't do the full raise, the stock has suffered since then. So sometimes it can work against you if the management can be shy about dilution because they own so much of the stock, can actually slow down progress for the development or exploration. So it's something to look at. It's not a hard line for me, but if they don't own very much of the stock, then you should at least be able to ask them why that is, and decide whether their answer suits, you know, your line of questioning.
Yeah. When you do a research on a certain company, do you rely only on the public? Do you rely on presentations and the things that are on their website, or do you contact a company and ask certain questions to them directly?
Always contact the company. Always contact the company. In fact, there's one company in the space that is notorious for not communicating with investors, even investors with relatively large platforms like ourselves. And you know, we sold the stock last year. That was one of the reasons. I mean, we felt that it was overvalued on a relative basis and put the money to work elsewhere. But the fact that the CEO was literally unwilling to talk to us was a huge red flag. And we're not alone in that. I've talked with other people in the industry, and they're like, yeah, he just literally won't talk to anybody. He's like, no, that's not okay. Always talk to the company. Always talk to the company. Even and most companies at least will get on the phone with you. Even if you're an individual retail investor, you don't have to have a platform like we do to get people to speak with you most of the time. So
yeah,
the other, you know, you have to be able to ask them the hard questions. And the really some of our best investments have come from investing in smaller cap companies at the time when we had a good relationship with management and we had an understanding of what they were trying to do. So, the presentation will make every company look great. And they might tell you, okay, we're a near-term development company. We've got an exploration asset. We've got blue sky exploration. All of them have blue sky exploration, right? We've got blue sky exploration over here, but we can develop this asset with this level of pricing, and it's going to cost this much. We'll be able to produce this much, et cetera, et cetera. That's what the market knows. What the market doesn't know is really where you can make money. So if you can, and I'm not saying this is like insider trading, but if you can pick up where the company wants to go eventually, and you believe that they will be able to do it, those have been huge wins for us. Because what has ended up happening is not that we knew that they were going to do XYZ because we didn't, but if the company pulled off a very intelligent acquisition at some point that was in line with their general strategy that we understood due to speaking with them, you can pick up a lot of breadcrumbs from having a conversation. And I'll actually strongly recommend having a Zoom conversation or an in-person conversation if you can, because you can pick up a lot from somebody's body language and the way that they're speaking and what they're saying rather than just hearing their voice. So all of these things, they're anecdotal, but they're very, very important.
Yeah, I agree on this. And the best thing is when I go to a conference, when I meet in person with CEOs, like you said, the body language is the best thing you can see on one CEO. Eyes don't lie.
Right.
Justin, before I let you go, I have a series of B&B questions. Those are 10 questions with regarding of other commodities. B&B, why are they called B&B? Bullish, neutral, or bearish? I say commodity and you say bearish, bullish, or neutral, okay?
All right, rapid fire.
Okay, let's get, the first one is copper.
Generally bullish.
Okay, silver.
Bullish.
Gold.
Bullish.
Oil.
Bullish.
Bitcoin. Here comes the bearish one.
I would say that I'm neutral. I just don't know enough about it to really have a strong take.
How about lithium?
Most likely bullish.
Tech stocks.
Neutral.
US real estate market.
Neutral.
US dollar.
Bearish.
Okay. And final, bank stocks.
No opinion.
Okay.
Most of these commodities that I said I was bullish on I tend to be a long-term investor. So I see a bullish outlook in the coming years for all of the commodities that you mentioned, essentially, primarily due to fundamental demand picture. I don't know very deeply the supply side of any of those commodities. And of course, the oil market, for example, if we see a deflationary recession over the next 12 months, we could see a neutral to falling, oil price in the short term. But in the long term, I'm bullish on oil. And long term, I'm bullish on basically all the metals. And especially the battery metals. I think all of the signs are there that multiple countries are moving, in some cases very swiftly, towards a quote unquote green transition that's going to need an absolute mining revolution. So to the extent that that plays out in the direction it seems to be heading, that should put pressure on basically all of the metals. So long term, I'm bullish on most commodities, let's say for a 5 to 10 year period going forward.
Okay, Justin, that was a great chat. I would like to thank you for coming to my show and wish you all the luck with your business and in your private life.
I really appreciate it, Lucian. Thank you so much for having me.
Thank you, Justin.